Welcome to your ultimate pit stop, Piston Pundit. Today, we're diving into the recent deceleration in the EV market's growth. The past few quarters have seen a significant slowdown, so much so that last year's sales figures fell short of expectations. With EVs making up less than 8% of all new vehicles in the US, the industry is hitting the brakes. Carmakers are delaying their EV investments, the government and EPA are revising their plans, and dealerships are far from thrilled with EVs gathering dust on their lots. In short, the EV market is experiencing a downturn, and we've identified 7 clear signs. So, buckle up and let's get started. Indicator number 7, shifting gears. Perhaps the most telling sign is the recent U-turn by the EPA and Biden's administration. Last April, the EPA proposed stringent emission rules aimed at driving massive electrification in the coming years. The goal was to have 2/3 of new vehicles fully electric by 2032. However, given the current trend, they've had to rethink their strategy. We've recently learned that a revised plan is in the works, aiming for 50% of new cars to be electrified. Some experts speculate that this figure includes all forms of electrified vehicles, including hybrids and plug-in hybrids. Regardless, one thing is clear. The government has tacitly admitted that their initial plan was more of a pipe dream than a well-researched projection. Furthermore, many experts predict that even this revised plan will need further adjustments, suggesting that we're still decades away from EVs dominating the market. Indicator number 6, deep discounts. As the EV market decelerated, automakers had to rethink their strategies. With dealer lots overflowing and demand lagging, they resorted to slashing prices, leading to significant discounts, particularly for luxury EVs. Ford, for instance, offered substantial discounts on the F-150 Lightning, but even then, sales didn't surge. They've even halved this year's production to clear the backlog of EVs. Tesla, the sole high-volume EV manufacturer in America, initiated this approach, pushing traditional car makers and startups into deeper losses. Companies like Ford ended up losing around $36,000 on each F-150 Lightning sold, totaling a loss of about $5 billion in 2023. Consequently, these companies are now delaying their EV investments, hinting at a widening gap between Tesla and other EV manufacturers in terms of technology and profitability. Before we shift gears to indicator number 5, please subscribe to Piston Pundit. Your support fuels us to create more content like this. Now let's rev up for indicator number 5, dealers' reluctance to sell EVs. The EV market is currently grappling with a significant supply-demand imbalance, leaving dealers in a bind. Their lots are brimming with EVs, taking almost 120 days to clear, compared to the ideal 60-day inventory for gas-powered cars. EVs are slow sellers, requiring dealers to invest more time and effort, as EV buyers typically make 4 visits before purchasing. This slow demand makes markups impossible. Furthermore, car makers are demanding hefty investments from dealers for chargers, training, and more. Many are reluctant to comply, as evidenced by Buick losing half its dealers last year due to GM's aggressive push to sell electric cars. Indicator number 4, reliability concerns. Another significant factor slowing down the EV market and potentially leading to its future collapse is customer apprehension. It turns out that EVs are not as reliable as some have claimed, causing 80% more problems than gas-powered cars. Battery and charging issues, software glitches, poor build quality. These are just some of the grievances of EV owners. Except for Tesla, which is close to the industry average in terms of reliability, no other automaker has managed to produce a reliable EV. To make matters worse, the cost of repairs is much higher for EVs, leading to increased insurance costs and poor resale value. A recent survey revealed that EVs lose half of their value in just 5 years on average. Indicator number 3, the demise of startups. Once hailed as prime investment opportunities, EV startups are now on shaky ground, signaling a potential EV market crash. Take Rivian and Lucid, 2 of America's most promising startups. Despite backing from major investors like Amazon and Ford, Rivian is struggling. Last year, it lost $40,000 on each vehicle sold. leading to a staggering total loss of $5.4 billion. Lucid is in a similar predicament, having lost over $650 million last year. The crux of the issue: they're not selling enough EVs and their production isn't optimized. Rivian, which sold 57,000 vehicles last year, plans no increase for the next year and will lay off 10% of its workforce to cut costs. As for attracting new investors, it's a tough sell, with shares plummeting 20% for both companies just last week. In 2021, Rivian and Lucid were valued at $153 billion and $91 billion, respectively. Today, those figures stand at $10 billion and $6.9 billion. Indicator number 2, legacy carmakers don't have money for new EV investments. Just like startups, legacy carmakers are losing millions on EVs. We already mentioned Ford and its billions in losses, but the Blue Oval Company isn't an isolated case. Others are suffering too, and that brought an interesting trend lately. With the market slowing down and other factors in mind, legacy automakers had enough. They are not ready to invest in EVs anymore and lose even more money. Instead, they are postponing their investments indefinitely in order to save what can be saved. Once again, we can use Ford as an example, with its decision to cut the production of F-150 Lightning by half. But that's just the beginning, considering that the company made a decision to postpone $12 billion of EV investments planned for this year. Things at GM aren't much better either. The chronic lack of profitability caused some pretty interesting decisions, such as the delay of the most important EV prospect for the future, the all-electric Silverado and Sierra pickups. Their production now won't start before 2025, while the production of the new electric drive unit has been postponed for at least 9 months. Indicator number 1, customers are turning back to ICE cars. A certain number of American consumers bought an electric vehicle, while others got the opportunity to hear firsthand impressions. And it turns out that EVs are nowhere near as good as advertised. The ownership issues are numerous, starting from higher than expected running costs, problems at charging stations, range anxiety, and low reliability scores. With all that in mind, it doesn't surprise that the percentage of drivers who were dedicated to going electric dropped from 81% in 2021 down to 52.1% in 2023, according to a recent study. The same study also showed that only 37% of Ford Mustang Mach-E owners went for another electric car. On the other hand, nearly 46% purchased a gas-powered car, which clearly indicates that consumers are not interested solely in things like zero emissions. Things like vehicle type, convenience, and capabilities still matter the most, and in these aspects, electric cars obviously still aren't as good as their internal combustion-powered counterparts. Thank you for tuning in. Remember to hit that subscribe button for Piston Pundit, and we'll catch you in the next one.